you got to go back to simple principles rather than hundreds of pages of checklists where you cross your T that you fit into this one bucket.
All right, welcome back to the podcast. Very excited for today's episode. We've got the legendary, the great Axel Merk. Axel is an economist and an asset manager, probably in that order. I don't know. What would you say, Axel? Which one would you put first?
I have an undergraduate degree in economics. I have a master's degree in computer science, and yes, I'm an asset manager. But to that point, my wife is an engineer. You know the difference between an engineer and a computer scientist?
What's that?
The engineer gets stuff done, and the computer scientist will generalize the solution to a problem, even if the sample size is one. And it's relevant to our chat because I think we'll talk about fixing the banking system. I hate it when the basic building blocks are just bad, and so I have an inertia to come out and scream. And a part of the talking to you and the quote unquote screaming is, of course, just therapy because I'm so frustrated with what's happening out there.
Well, what do you mean the bad building blocks? I thought everything was fixed after the global financial crisis, right? Bernanke was a hero, and these problems are all the way down to the root cause have been permanently solved.
Yeah, we've known each other for over 10 years, and I don't know whether you've disclosed that to your audience. You used to work at the NYSE. That's where we got to know each other. And it was in part that I thought some building blocks weren't so perfect that we created some products that to address that within the limits of what's out there in the regulatory world. No, I mean the problem and the big frustration is in 2008 there was a big mess. We patched up the problem, but created others, didn't solve the underlying issues. And the big frustration is that we're repeating the same mistakes again. The difference is the problem isn't quite as severe, the acute one at least, and the fixes are somewhat simpler. But yet there is no proper debate about how to fix the banking system in this case.
So
we can fix the Fed another call, but today we'll just fix the banks, I think.
Well, what I want to talk about is, primarily the blog post that you wrote recently, where you said fixing the banks is not that complicated, and you go through a number of policies and what you think does not work and what does, and I want to kind of break it down and talk about it step by step. Why don't we start with what happened? I mean, right now we're recording this. It's April 13th. Everyone is saying, "Oh, the banking crisis, the mini banking crisis, totally averted. Everything is fine. The waters are safe. Go jump in, and there are no issues at all." I don't know. I kind of feel like, well, they're the same. It's like you said, where the root issues, the same root issues that caused the global financial crisis that were, quote unquote, solved with increasing regulations. Since that point, all I see is an increasing frequency at which the Fed or the FDIC or Treasury, whoever it is, the big government has to come in and rescue, and they're using bigger and bigger numbers at lesser and lesser efficacy for the amount of money that they're throwing at the problem. And it's happening at a more and more frequent pace. So it's like, it's kind of circling around in this, with an increasing velocity. And, that's with me with a much more surface level understanding of the issues than you do. Am I right in picking up on that? Is that what's happening?
Yes, and let me praise Jamie Dimon, and I know he's not popular with everybody in the blogosphere, the CEO of JP Morgan, but in his letter to shareholders, he wrote how these small banks are drowning in red tape. And I'm putting words in his mouth here, he didn't say it exactly this way, but they end up not seeing the forest from the trees. The industry better than most, right? There are lots of small banks, and they are not huge institutions, and they try to do the right thing. And so they send all their staff on crossing the T's so that they fulfill the requirements of the regulators. And in the meantime, they're missing the big elephant out there because they don't have the capacity to look at. I see that in our own business, right? We're not on the banking side, we're on the regulated securities side. Last year, we had 3 major new regulations come down the pipeline. Usually one is a lot of work. And of course, we're good boys. We comply with that stuff. But you drop everything else so that you scramble to comply with the rules. And my point is, let's have some simple principles, and I'll go into those here with pleasure in a minute here. Then you don't need to have a lot of the red tape that ultimately doesn't make the system any safer.
Right, right. I mean, I always, my frame of thinking of these things, of the bigger economic pictures, I always start with like the simplicity of the free markets are perfect. And of course, it doesn't mean that they're perfect in the sense that there's never going to be a crash or there's no cycles or volatility. That's the price we pay for economic expansion. But, you know, we start with the basic, like I always go back to iPencil, right? The iPencil essay, and just the idea that there's this perfect, or as perfect it can be, this perfect, you know, framework, which is zero intervention, right? And then every intervention is like, let's cover up the last thing by creating unintended consequences that we can't yet see, which is going to create the next one, which is going to create more. And it's like everything that we do, everything we try to do is getting in the way of what was a very clean, perfect system and just complicating it and making problems. And again, that's like, you know, that's kind of my framework of which, you know, the skepticism that I look at all these interventions and all these policies, and they're all well-meaning. I don't doubt that. And I'm sure you don't doubt that as well. They're all trying to...
Yeah, well, I maybe wouldn't use the word characterize the previous system as perfect, but other than that, let me first clarify. The role of the regulator should not be to prevent anyone, be that an individual or be that a financial institution, to make a stupid mistake. The role of the regulator is that, so if somebody makes a mistake, it doesn't wreck the rest of the system. And so that is, in my view, where they should be. Perfection is not the issue here. And in that context, right, we all remember Nassim Taleb's anti-fragility thing, right? Perfect safety is unsafe. I like Neil Ferguson, who's an economic historian. He wrote the book, The Square and the Tower, how he writes that if you have a very top-down structure, you have a very unstable system. You have a strong, you get more strength by kind of spreading the risk, and things like that, and those basic ideas. But let me maybe to put some substance on that. And you mentioned 2008. One of the core things of every banking crisis is insufficient capital, right? I mean, that's what the issue is, and the insufficient capital is a result of fessing up that you have losses. And so for some reason, the banking system is the one area left where you don't have to mark your securities to market. And you remember AIG failed because they said, well, if you only hold these products to maturity, everything is going to be fine. Well, guess what? It is not fine, right? And to illustrate of why this is important, and there are all these safeguards and stress tests and so forth. But let me, as an example I love to give from the financial crisis. For those of you old enough, you may remember that the price of oil went up from, I say 80 bucks, I think it was a little lower than that, up to 145 bucks and then crashed down to about 40 bucks. So assume you were at a stage where oil was $80 a barrel. And you thought, oh my God, there's a problem ahead. I'm going to take a bet that the price of oil is going to go down. Well, if you just had a short position, a simple short position, you would have made a lot of money. But if you had levered yourself through the nose because you figured this is the best trade ever, you would have been out of business, because as the price of oil was going higher, you would have had margin calls. Now, you could argue, hey, had I only held this to maturity, everything would have been fine. But the point of the mark-to-market accounting and the associated margin call is, assuming those rules are known ahead of time, which is hugely important, do not change the rules along the way, that is a disincentive to use excessive leverage. And that's precisely what we need. So this is not rocket science, right? And so if you told the banks, and sure, the banks disclose in the small print what the unrealized losses are, but if you told them that there are consequences of unrealized losses, well, guess what? They'll think twice on how to manage that. Instead of what we're getting is, we're getting the regulator that tells you everything is safe. And the reason why that doesn't work, that's also not rocket science, right? The regulators, by definition, will be backward looking. They will fix the last crisis. And I'm not saying there shouldn't be an element of that. I mean, sure, you should learn from that, but you need something that's forward looking. Well, what is forward looking? The market is forward looking. The only thing left now that's forward looking is the stock price. And so everything is fine until somebody then runs for the hills. We have all but taken away the depositor responsibility, because implicitly there may now be more than $250,000 insurance. But a bigger mistake was made in 2008 when we killed the intrabank funding. It used to be that banks got funding by lending to each other their excess reserves. Well, guess what? These are unsecured liabilities, and banks would have thought twice lending to Silicon Valley Bank. But we've taken that away because, hey, you can get your funding from the government, from the Fed, or an equivalent place, right? And so we're taking away market-based measures of risk, relying on a bureaucrat that's backward-looking, and then we're surprised that the stuff doesn't work.
Let me back up a bit, because all these things, mark-to-market accounting and interbank lending, those are all, prescriptions that you had in your blog post, and kind of diagnosing the problem and then prescribing what you think could simplify and solve the problem. And I agree. Look, disincentivizing leverage and these moral hazards that pop up from the regulator, it's the same themes that come up every time one of these crises. I want to just, for our audience, I want to just take the conversation back a step here, and tell us what happened. Like, we had all of a sudden, out of nowhere, it seemed like out of nowhere, Silicon Valley Bank and Signature Bank, poof, blew up seemingly overnight. The depositors were made whole, right? And Credit Suisse, just a couple weeks later, blew up, and Credit Suisse has been blowing up for the last 5 years, it seems like, every month, but finally this is the one that did it. What exactly happened?
Yeah, I'll stay in the US for now. There's plenty to talk about. So what happened was that during the pandemic, Uncle Sam decided to write a lot of checks. And that means everybody got a little check and this and that, and lots of people had lots of cash, and they brought them to the local bank account. And so the deposits at the banks swelled. And then the banks invested that stuff in the quote unquote safe stuff, treasuries, and not just T-bills, but longer dated securities. And then what? Well, the economy opened up, interest rates went higher. Banks historically give lousy interest rates. And so you started to see people spend down some of the money they had put aside. And then, importantly, of course, there's a flight to money market funds. And then as interest rates move higher, there's interest rate risk in treasuries, even if there's no credit risk, at least by regulation. Which means bonds fall in value, right? When interest rates move higher, longer-term bonds tend to lose in value, which means there's an unrealized loss. And the way that banking regulation works is that if you have them in a bucket where you say you hold them to maturity, you can pretty much all but ignore it. But the left and the right hand of the balance sheet are getting to be out of whack when suddenly, well, what are you going to do if people pull their money out? Well, guess what? You have to stop selling the securities and realize the loss. So that's the basic principle. Now, Silicon Valley Bank, of course, when the tide goes out, you see who swims naked. Well, Silicon Valley Bank was a bit of an extreme example in that. First of all, when interest rates go up, there are plenty of tools out there to manage interest rate risk. First of all, you don't have to buy the stuff. And then there is a whole market out there, the most liquid market out there that you can imagine, for banks to manage that interest rate risk. But again, like some of the smaller banks may not have the capacity in-house, but Silicon Valley Bank was a $200 billion bank. They weren't exactly tiny. But Silicon Valley Bank I had a problem with already 10 years ago. I can't speak up about publicly traded companies the way I'm regulated, but they were always run like a venture capital fund, right? And that's the attitude. And so I already was wondering 10 years ago, well, what the hell are they doing? And well, now I realize what they were doing wasn't maybe so perfectly appropriate. So it was a more extreme example of what was out there. and then of course what happened in Silicon Valley Bank is because they attract the money of venture capitalists and the startups they are funded, it's all a click, right? One of my daughters is a startup entrepreneur. She lives in a house with other founders. So any rumor that spreads within one venture capital firm's clients, their startup companies, spreads immediately to the entire ecosystem. And so and then people blame social media. Well, first of all, what you need to blame is Silicon Valley Bank, right? And of course, and it's not social media that amplifies. Even if there was no social media at all, the word within the venture capital community spreads extremely fast, always has. And then of course you had large deposits there. Now, let me just like to you mentioned just two banks. I would like to expand that discussion, but just within those banks, right? There was this fear. Oh my God, there would be a huge problem if they were to fail. Well, a few things. There is a private sector that jumps in as well. When you have a bank failure, the difference between bank failures in the US and the Eurozone debt crisis is that we have, or thought at least we had, a sound institutional process on how to wind up these failing banks. Bank failures have happened, will always happen. The way you avoid a panic is to have a sound institutional process and also fixing the underlying issue, which we're not doing here, by the way. And so the FDIC coming in, seizing an institution, is that process. And then anybody with an insured deposit can have access to the money right away, pretty much. The problem is what happens to the unsecured? Well, it doesn't mean it's all gone, the money, but the way the system is supposed to work is, well, you then take care of the liabilities and then you see what's left and distribute what's left. It appears that they would have retained about 90% of what they had. So they would have had a 10% haircut for their lack of doing due diligence on where they have the money. And the question is that an acceptable punishment, a risk, so that you have the market mechanism, and we can talk about it. I happen to believe it is. Importantly, that weekend when this happened, I was at a dinner party. Somebody was late for the dinner, and she is affiliated with the venture capital industry. They were providing bridge funding for some of the startup companies they're in. And in the Wall Street Journal, a few days later, they wrote that this was apparently done throughout the industry. So the industry was stepping up to provide bridge funding. The other thing is, when you get an FDIC receivership certificate, you can get a loan against that. So it's not like the wheels would have come grinding to a halt. Now, would that have been a bust in Silicon Valley? Yes, of course, right? But guess what? Silicon Valley has always been a boom and bust industry, and this would have been a bust, right? And so is this the end of the world? And should you throw out the rule book because suddenly there is a shock to the system?
Here's the one argument that I have sympathy for is because I tend to agree. I think that when people take risk, then both sides of that risk should, if it works out for them, they should reap the benefit. And if it doesn't, then they should take it and not, this idea that, oh, the government is, socializing bank losses, but privatizing the gains. I have a lot of sympathy to that. But if you say that I'm running a business, I need a checking account, right? At least in the modern, I need a bank to run a checking account. And you say, well, you could still, assess the bank risk. Well, if I'm the chief operating officer at a technology startup, right? I don't know anything about banking. The regulators missed it. The auditors missed it. The rating agencies missed it. All the experts, all the people who are supposedly able to assess bank risk, they all missed it. So we're saying that, mom and pop checking account holder, depositor, right? And all these businesses that are just trying to run their businesses, they are supposed to do their own due diligence on the bank. And if they're taking risk by depositing money in a bank that's not hedging their duration, right? Or that's taking on risk, that's on them. But how could we possibly expect these people to be able to assess that risk?
Well, first of all, there's a lot of blame to go around, no doubt about that. Second, the mom and pop depositor, those with deposits under 250,000, they're protected by the FDIC. It's again this thing about you make the rules of the game clear, and then you work with those rules.
Right.
And so that's my framework. I do believe the system works better when you stick to the rules you have in place. And if you don't like the rules, you change them, but you don't change them in the middle of a crisis. And so, yes, I do believe, and there's also been coverage on that, how small business people are doing due diligence. When you put money into the bank, you're giving the bank a loan. I absolutely do due diligence on the bank. If there's one lesson from 2008, is that you have more than one custodian, that you put your money into more than one bank. Well, guess what? That accelerated the capital flight because now people had options, right? They were able to move the money somewhere else. So there's always a little bit unintended consequence, but it's not like there is no consequence of suddenly the government bailing things out. What is the purpose of small banks? Because it's a soul searching that we have to do. Because right now, why shouldn't you put all your money into a too big to fail bank? And we can talk about kind of how to mitigate that issue a little bit. But it of course pulled money out of other small banks to see, oh my God, they're bailing out the big banks are too big to fail, but the small ones have a problem. So there are some complicated issues. Now, let me just stick out a little bit here on the Silicon Valley Bank fallout. There was a third bank in the news, and that has disappeared from the news. But what has happened there? And I'm talking about First Republic, and I'm not making any investment recommendation on them here whatsoever. But suddenly it's gotten quiet about First Republic. And why is that? As some may recall, the big banks under the leadership of Jamie Dimon put something like 30 billion of money as deposits, uninsured deposits, into the bank as an expression of confidence. In the meantime, the capital flight from them and others continued. And by the way, there was a study, don't have the latest update, but half the capital flight was to money market funds, half of it was to the bigger, too big to fail banks. And so some of that flight might have happened anyway, but it wasn't enough. There was continued to be a drain. And at the same time, First Republic still hasn't raised capital. And if you look at what the issues are in the system, it is a lack of capital. Now, why haven't they raised capital? Well, a big reason is because they got this wonderful facility from the Federal Reserve where they can deposit their underwater securities, their treasury securities that are underwater, and get 100% of the notional value in funding in return. What does that do? That converts an acute problem into a chronic one, because the acute problem was, oh my God, we have to sell things at a loss. Well, by parking the stuff at the Fed and them bending the rules quite severely of what they're supposed to be doing and giving liquidity for that, now the banks can live another day. But of course, they'll have to pay interest on that stuff. In the meantime, they might have still deposits, so they're postponing the day of reckoning. We're creating 1990-style Japanese banks that will not be lending. Remember, there's going to be a lot of scrutiny on this stuff now. If you have holes in your balance sheet, you're not going to be lending aggressively. But at the other end, coming back to that is if the market cap, I didn't look it up now, but was around $2 billion of little $2.5 billion, give or take, of First Republic. Well, a capital is so much more powerful in a fractional reserve banking system than a deposit. So if you convert the capital into a deposit, then you can have a sound bank. But imagine if you own 100% of the shares of 2 billion and add 30 billion. Well, you do the math. There's a little bit of a dilution to existing shareholders, right? Or dramatic, to be more explicit, for those who don't get my sarcasm here. And so there is a disincentive here for the banks to raise capital. And what's been happening is that what the Federal Reserve has done, and also, by the way, the deposit guarantees, those are disincentives to raise capital. So the core of the issue, the lack of capital, the regulators providing a disincentive for. You need to work with, not against, market forces if you want to fix the crisis. And of course, the argument for bailing out the depositors was that, oh my God, this would spread. Well, of course it would spread to the insolvent institutions. But the solution is not the Band-Aid. The solution is that you tackle the insolvent institutions, right? If you don't fess up to your problem, you're just extending the agony. A central bank can keep an insolvent banking system afloat. I mean, you saw it in the Eurozone in the last decade, you saw it in Japan in the 90s. The central bank can keep the system afloat, but there are real implications for economic growth. Yeah, I think there's socioeconomic implications as well. I happen to think that we got Trump elected, and part of the reaction of policymakers to the banking crisis. We can talk about that, but the core issue is that the policymakers just don't get it. That they would need to work with the system and rather than doing these stupid band-aids.
You referenced 90s style Japanese banks. What does that mean?
Well, in Japan, the banks had made huge real estate investments, and then the housing market collapsed, which means the banking system in Japan was insolvent. And the Bank of Japan kept them alive, but the result has been subpar growth in Japan. I mean, it's obviously an oversimplification, but what happens is a central bank can keep a banking system afloat, but a weak banking system will not extend credit, and economic growth suffers as a result from that. And so you can patch up and bail out everybody, but there are real consequences. And I just mentioned Trump here. Let me just expand on that to say that this is more than just a financial issue. You cannot blame the young generation to turning their back on capitalism because they think what's happening in the US is capitalism. It is not, right? Or to say, hey, these banks were bailed out in 2008, others lost their job, and they think that the system is rigged. Well, it is rigged when you as a regulator do stuff that's just completely inappropriate for the sake of living another day. My view is that the best short-term policy is a good long-term policy, and the exact opposite is happening. And guess what? People get upset, and then they vote for more populist politicians. So I would say there are political consequences to these sort of things.
Yeah, I mean, look, you talk about how, what we're getting now is not capitalism, yet capitalism is blamed. I was shocked, and you referenced this in your blog as well. I was shocked there was a Senate hearing with Janet Yellen on this issue, and the senator from Oklahoma, I think Langford is his name, was asking some tough questions, and Janet Yellen essentially said that it is our arbitrary discretion to decide which banks get expanded FDIC coverage and which don't. She said it's based on myself in the White House and the Fed governors to say this poses a systemic risk. I mean, you talk about crony capitalism, you talk about the politicization of the economic policies. I mean, that's just putting it all out on the table.
Well, let's talk some substance here.
Yes.
So just since the Honorable Janet Yellen here. So Janet Yellen is an academic, and it came out in that presentation. And there was especially the juxtaposition, Yellen testifying and Powell speaking. Well, Powell has his emergency tools and just prints another trillion and can kind of patch over the little details and then just tries to be smoothing the markets, whereas Janet Yellen wants to be precise. And she gave a very precise answer, and with that created a lot of confusion. In order to go above the $250,000 limit, you need a supermajority at the FDIC and the governors at the Fed, the governors excluding the president, and you need the Treasury Secretary who needs to consult with the president. And she exactly expressed that. And so she was very technical in her answer, but there's also, from the early 90s, a law that was passed that there's a limit to what the FDIC can do. Under an emergency measure, they could enhance that protection, but they can only do it for a limited time. Otherwise, they have to go back to Congress. And that's, of course, a political hot potato, right? And that's one of the reasons why you shouldn't go down that path in the first place. And so she was just explaining the law as it is on the books. But at the same time, the main takeaway I had from this meeting and this discussion was how she was asked, well, doesn't this suck the money out of the banking system? Of all the people, she should be able to see the forest from the trees. And and she clearly doesn't appear to. And this is, as you know, right? I know several folks from the Fed more closely. We work with the former St. Louis Fed president, Bill Poole. He retired in the spring of 2008. He used to be known as a vicious critic of the GSEs of Fannie and Freddie Mae, and has very strong and interesting views. He might be a good guest for you one day on what's happening out there. But my experience in having gotten to know some of these policymakers is they work with the best of intentions, right? And that's why I say, hey, the road to hell is paved with good intentions. The issue actually I take with people, a lot of people have conspiracy theories. Well, the problem I have with the conspiracy theories is they imply if you only get rid of the bad apples, you fix the issue. Whereas I'm actually far more pessimistic, is saying it is the good intentions of the various people that gets us on this road we are on. And the very serious question I have is, well, how do you give policymakers the incentive to go and make the right sort of tough decisions? I mean, ultimately, it of course bears down to leadership, amongst others, but it's just very, very frustrating to watch all of this play out.
Yeah. Well, one of the things that I really enjoyed about your post and about your commentary on all this is you didn't, enough of us, I do plenty of it myself. We just complain about the problems, but you actually listed out very practical, real solutions that may or may not be, fall upon deaf ears or put into place. But, let's talk about those. I mean, what would you do to fix the problem and to fix the real, not just to fix the last crisis, but to fix the root issue? What would you do?
Well, I mean, some of it I already mentioned, right? That you'll mark your portfolio to market, and obviously and you have margin calls. I mean, those terms are used slightly different in the banking industry, but that's very simple, right? Another bucket that we haven't talked about is to address the too big to fail issue. You mentioned Credit Suisse earlier, and one of the things in the news was the subordinate debt that was wiped out without the equity shareholders wiping out, and all of that is unfortunate to put it mildly. But the broader thing is the Federal Reserve put on its website, I think it was 2000, the topic of subordinate debt. If banks were to coerce to have a big chunk of the capital in subordinate debt, not just a little bit to bail in here and there, but a big chunk, and have that spread out over 10 years, refinance a tenth of that each year, what would happen is you would have a market-based regulation of taming banks. So if there were a hostile environment where banks couldn't fund themselves at an acceptable cost, they would have to shrink about 10% of the balance sheet. And that's perfectly possible. What is not possible without a big blow up is banks shrinking 50% of the balance sheet. And that's what's happening now, right? And so there is an idea that's long been on the table. I understand the idea was proposed to Greenspan at some point on the side, and he thought it was maybe a little bit too complicated. But that's the sort of thing that would be very helpful, because then you don't need to have the big banks to be somehow in a super protected status if they were subject to a similar sort of set of rules. And it goes back to, and I mentioned this as well, right? You've got to go back to simple principles rather than hundreds of pages of checklists where you cross your T that you fit into this one bucket. And because treasuries are safe, nothing can possibly go wrong. Well, gee whiz, yes, it can, right? I mean, we haven't talked about commercial real estate yet or some other stuff, right? So it's and then related to the mark-to-market issue, it's capital, right? You need to coerce banks to carry sufficient capital. And they hide behind a complex set of rules and stress tests. It says, oh, if you only hold the stuff to maturity, everything is fine. Now, I understand some of it is part of the Basel III agreements and all that stuff. But if something is broken, then fix it, right? You've got to approach that sort of thing. And then, very big topic, I alluded to that as well, the private sector, right? The people said, oh my God, and Silicon Valley is going to change, right? Whoever buys or bought Silicon Valley Bank is not going to provide exactly the same services because the way that the services were provided wasn't quite appropriate. there is no problem in providing capital to startups, but it shouldn't be Fed insured money, right? Fed guaranteed money. You have to build a private sector infrastructure of risk capital. You need to match the sort of risk profile. To jump ahead here a little bit, like commercial real estate. A lot of banks hold commercial real estate. Well, suddenly, as of a few days ago, that stuff is trading like junk. Well, there is no problem with that stuff trading like junk, but there is a problem of a bank that's supposed to have a tighter risk management and a lower risk profile holding stuff that's excessively risky. So that sort of paper needs to change hand and move over to hands that's able to cope with riskier stuff, right? There's nothing wrong with taking risks. Knock yourself out if you want to do it, but don't expect to rely on the Fed to bail you out if you blow up. And of course, then you need to make sure the rest of the system doesn't blow up. So there are some simple things that one can do. And instead, Dodd-Frank blamed, in my view, to a significant extent, not all the right players, and then just had a political agenda how to do things. They got us to the environment we're in, where they killed a lot of risk taking that was appropriate, and now you have the wrong types of mix of risk takers in the market, where you have liquidity that's maybe a penny wide but only skin deep. And then you know about that stuff more than I do, having worked at the market at the NYSE, right? So it's and we haven't even talked about all the problems that the Fed has covered here, because that's in some ways a separate conversation. But it's there is stuff one can do, right? And instead we just have somebody patch up the thing to live another day.
And what a surprise! Every iteration, every new regulation, every new policy, the government and the regulators get bigger and more powerful. And never with a moment of self-reflection of saying, hey, we have all these resources and rules in place and it didn't help and this or that blew up. Instead of maybe we are part of the problem as much as we want to be part of the solution, but that's never addressed. They never say, hey, we need to get out of the free markets. We need to that's never, it's a one-way wrench. It only goes one way. The government only gets bigger. The Fed and the bureaucrats, they only get more and more power. They only print more and more money. And it's like, look, they can keep patching it up for, who knows how long, maybe another generation, maybe another 500 years. But eventually.
Yeah. Sorry. You'd be amazed how good policymakers are at kicking the can down the road, right? And the problem is, right, we're both investors. So let's take a position on this. Well, when the rules change, you get whacked. Whacked is a CFA level 4 term, so maybe not all your listeners know that. But it's if you did the right decision in 2008 based on what you saw, you likely lost money because of another bailout. And so over the years, we've actually lost a lot of skill, because those who actually think how this should play out have been pushed out of the market. And so now suddenly all hell breaks loose and people don't know what to do, because the only thing they know anymore is how to do index-based investing. And so it has implications in all directions. Now, we can blame and mock our politicians. To me, I'm naive enough that I think, well, maybe we can change something. And so that's why I'm screaming up some trees and saying, well, do something, right? And it's probably naive, but it is a very serious question, right? What can each one of us do so that the system becomes more robust, aside from just complaining that they mess things up? And that's in part why I'm giving somewhat more specific proposals of how to solve it, which I think are all reasonable, but then again, I'm biased, right?
No, I share that concern. You look, I've never worked on the debt side, on the credit side, but it seems to me you've got these zombie companies that are able to borrow indefinitely at artificially low rates and keep themselves afloat. And now rates are coming up, and let's see what happens. And the investors that I work with, right, the financial advisors and a lot of the asset managers, there is frankly no concept of understanding beyond the credit rating bucket that you're in. And, in some cases, market cap weighting, which in fixed income means you're you're most allocated to the companies with the most amount of outstanding debt. And there is no concept of, is this company viable? I'm lending money. Is this company viable? There's no concept. Obviously, everyone knows on the equity side, right? Value investing has, like you alluded to, it's underperformed. This tidal wave of flows driving performance in market cap weighted and high beta, and that's knocked out a lot of the players, the people that actually bother to read a 10Q or a 10K, the people that actually bother to understand what they're owning. They're not setting prices anymore. It's all just Delta One, ARB desks and this steady flow of market cap weighted. And again, nobody sees a problem with this until there's a problem, right? As long as it's working and we can keep artificially high prices, artificially high forever. And that seems to be the goal here. Let's keep these things at unsustainable prices forever, indefinitely, until it just blows. And I don't know, again, I don't want to be all doom and gloom, and I don't know when that happens or if that happens. But it does seem to be, like you talked about earlier, everyone always addressing last year's risk. It does seem to be this massive risk in front of us, not behind us, that we have not come to yet. And instead of getting ahead of that and thinking about liquidity in the markets and who's going to support these prices if we blow through that thin layer of, Delta One ARB market makers, right? What happens? Who's actually setting prices? Who's willing to buy this stuff in a declining market? It's not being addressed.
So let's briefly, without going too much off topic, talk about commercial real estate in this concept. I mention it in this context because a lot of small banks hold a lot of those loans, and just how this stuff works in simple terms, right? In the US, we got a lot of reasonably short duration funds. So you just a limited time of years, they gear themselves up. And so what happens is that they borrowed them at very low money, at very low rates. And then now there's a reset coming up for many of these loans at substantially higher rates, often like 3-4 times as high. In the meantime, office occupancy rate has come down. So do the math, right? Revenue's down, expenses up. And so these loans are very building specific. And so if you're a fund manager thinking, I'm not going to make money with this loan, well, you hand the bank the key over to the bank, right? And so and so what happens? The bank is not in the business of running these things, so the bank is going to dump that stuff on the market, which is just going to kind of escalate this thing and create lower valuations for commercial real estate. Now, the Fed can, quote unquote, bail it out by going back to zero in interest rates, I suppose, and they can refinance cheaper, and they may be forced to do that in 2 or 3 years down the road. But this is a crisis screaming to happen. And again, right, it's not a problem that there's risk in the system, but the risk should be within hands that can bear it or can absorb the losses, right? In 2000, in the tech bubble burst, we didn't have a meltdown. It's because the risk was spread in hands where it was appropriate to be held. It doesn't mean you or I can't suffer a loss, but the system as a whole is far more robust and stable when that happens. And so instead, people are apparently ignoring it. I say apparently because I didn't see a big discussion in it in the Fed minutes. I mean, it is part of the downside of this amazing transparency we have, that people don't discuss anything anymore because they might potentially rock the markets, right?
Right.
So it's and by the way, I don't want to talk about the Fed too much because I'll never stop talking. But this stuff is going to happen with a lag, right? And so there is no way once this stuff starts unwinding that with a snapping of the finger, you can stop that sort of fallout from happening.
Before we break, I want to ask you about stagflation as a concept, what it is, and then what to do about it. You launched a fund that I think really hasn't gotten its due yet in the market. I think it's really ahead of its time. So tell us about that. Tell us about what stagflation is generally, and then depending on what compliance rules are, if you can talk about the fund, if not, talk about more generally how one might want to address stagflation on the portfolio level.
Sure. Well, in May of last year, we launched the Merk Stagflation ETF, and it's an ETF that's structured to potentially profit from a stagflation environment. And one way to think about what stagflation is, we think about it as a policy, as a supply shock followed by policy mistakes. So when you have a supply shock, the politically attractive thing to do tends to be economically counterproductive. So think about the stimulus checks. If heating costs are too high, and if you give people a check to pay for heating, that's not going to increase the supply of energy, of oil or gas, right? And so the politically attractive thing to do is, of course, let the price go higher to have supply and demand go into balance, but that's cruel. And so politicians don't want to do that. And that's the same as why we had price controls in the 70s and other things. And we think we are so much smarter than the 1970s, but we are still human. And so policymakers will still be prone to these things. And so we looked at what worked well in the 70s, obviously realizing it's not exactly the 70s, but we looked at, well, what sort of thing performs well when inflation expectations move higher. And then of course what we looked at is inflation protected securities, oil, gas, and real estate. And the bulk of the fund, a big majority, invests in TIPS, inflation protected securities. Some people say, "Oh my God, why do you have so much?" Well, we see this as a potential replacement for a bond. Obviously, if you think that a certain investment is going to be the best thing since sliced bread, you knock yourself out, gear yourself to the moon, and invest in just that. But this is intended more as a replacement for bond holding, and most people don't understand TIPS too well. We have on our website an analysis of what TIPS are about. When you buy TIPS, you're locking in real interest rates over a longer period. And I don't want to get too technical. It's what the market is pricing in. Obviously, nobody knows exactly what inflation will be in whatever 6-7 years from now. But one of the reasons why we've had lukewarm performance is because, of course, when the Fed is super tough, they're pushing up real rates. And so the question is, have we reached peak hawkishness, right? Once we've reached peak hawkishness, I believe we happen to be, then that sort of investment will do well. Gold, I don't think it's any explanation in the stagflation environment. 1970s has done well. By the way, in the 70s, on a real basis, net of inflation, the stock market hasn't been great. And so a motivation to bring out this fund is to provide another diversification tool. And then oil has historically done well. And then real estate we have in there as a small portion as well. And we package all that with a bit of a trend following methodology where when something moves well in the oil, real estate, and gold bucket, they get a bigger allocation. And the reason we do that is because in the 1970s that has done well. And so if we look at that final product, to us, based on our analysis, it can serve as a good diversifier and in a stagflationary environment particularly well. And just one word on more stagflation. And here I'm quoting our big hero, Ben Bernanke. Even he says that once inflation is high, it doesn't just go down, it becomes more volatile. It's a process that lasts many years, right? The stagflation of the 1970s actually started in late 60s till the early 80s. So this isn't just a 3-month thing, a 3-month product. This is a longer term thing. So anyway, STGF is the symbol. Do your homework, read the prospectus. But yes, we launched that product, and we are passionate about the stuff we do. Just for broader context, for those who don't know us, we manage over $1 billion, mostly on the precious metal side, gold and gold mining, and otherwise like to talk to people like Phil to make the world a better place by fixing the banking system and beyond.
Axel, where can people read more about yourself, your thoughts on the economy, your funds? Where can people follow you?
Well, 2 places, merkinvestments.com. Look around what we do as a newsletter, a free newsletter to sign up for. And then I'm freest on Twitter. I can't talk about products there, but you get my unfiltered thoughts here on many of these topics. At Axel Merk is my handle.
All right. Well, thank you for joining the podcast. Thank you to our listeners for your time and attention. And we'll be back real soon.
All right. My pleasure.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.